Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, March the 12th, 2026. Okay, so obviously the market is still very, very focused on oil. Let's just have a look and see the situation in the Strait of Hormuz. This is actually from yesterday, so I don't have the updated numbers for this morning. But as you can see, this is the outbound transit, so everything leaving. And you can see, I mean, it's pretty obvious. I don't really need too much explanation here. You can see that since the war started, which basically is this weekend period here back at the end of February, you can see that traffic both for oil tankers, which is the blue, nat gas, LPG tankers, liquid natural gas, container ships, everything, it's come effectively to zero. The only ships which are, as I say, effectively moving through the Strait of Hormuz at this point, there's one or two Greek ships, but essentially that's Iranian sort of focused ships, and apparently they've moved out about 12 million barrels of oil since the conflict began, which is not that much, all considering. So as you can see, it's basically sort of stopped, and this is the problem. So obviously yesterday we heard about the Strategic Petroleum Reserve release, 400 million barrels, coordinated release from the G7 nations, including about 180 million barrels from the US. But the reality is that that's going to take, it's going to kind of dribble through to the market. It's not as though suddenly there's 400 million barrels. What that means, for example, in the case of the US, is approximately 1 to 2 million barrels per day, which is going to be released physically onto the market. And in the case of, globally, the numbers I'm reading is saying that, it's going to take kind of like 5, 6, 7, 8, 9 days for actually the mechanics of all this oil to be released. So is it a short-term safety valve? Yes, it's a positive. But overall, keeping in mind that the world consumes about 102, 103 million barrels of oil per day, this is going to take off some of the pressure, but it's really just like a band-aid. It's just like a very short-term measure. And ultimately, the estimates I'm reading and most commentators and analysts are saying that we're losing about 10 million barrels per day of oil not exiting the Strait of Hormuz, as we can see here. So the point is that we have a deficit of about 10 million barrels per day, and the strategic petroleum reserves are probably, 2 or 3 million barrels a day globally, sort of coming back onto the market. So there's still a huge deficit, very, very simple. The other issue as well is the issue of when will this stop? So what we saw overnight, there were some pretty dramatic pictures of, let's just go to the oil chart. There were some pretty dramatic images of oil tankers being sort of attacked and sort of engulfed in flames, and that's not a good sort of look. And so what we can see here is that oil, despite this is on the daily chart, so we can see that despite the release yesterday, or the announcement of the release of 400 million barrels globally, as I said, from the strategic petroleum reserves of the G7 nations, you can see that oil's kind of dipped down to this pretty key level down there, about $82. But then subsequent to that, there's still sort of talk of, I mean, what's the reality? The reality is that tankers are physically being sort of attacked and are exploding and inflamed. There's no Navy escorts yet organized either by the United States or other sort of nations. And then secondly, there's no sign at all of the three main protagonists, so Israel, Iran, and the US backing down. There was even talk yesterday that there had been a plan formulated by the Iranians of attacking California with drones, which sent the oil market into a tizzy on that news. So the point is that the three main protagonists seem fairly much dug in at the moment. And one of the issues is that Trump, I think, was counting on the fact that, when, as he likes to say, when I want the war to end, it will end. And I'm sure that the political ramifications, the domestic political ramifications, as they ramp up with higher gasoline prices, and just looking at gasoline here, you look at RB contract, you can see the gasoline is ramping up. But the problem now is that the Iranians are saying, hey, we want future guarantees of no attacks, and we want reparations and this and that. And the Israelis seem to have absolutely zero interest in ending the war. Because I think also there's a sort of a slightly different sort of perspective here. People like Foreign Secretary or Secretary of State Rubio and Secretary of War Hegseth, they're basically now trying to push up this sort of narrative that there are sort of quite strict and narrow military aims for the US, destroying the missiles, the missile launchers, the capacity to make missiles, the uranium enrichment plants, the sort of the nuclear plants, and giving themselves a plausible exit plan, which I think Trump is probably increasingly wanting to do. But the Israelis, on the other hand, see this, I think, as a chance to sort of destroy, like once and for all, Hezbollah, in Lebanon, massive attacks happening in against Lebanon, especially in the southern parts of Beirut, and then also to destroy sort of existentially this threat of the Iranian regime. So I think as well there's a divergence happening, much more hardline from the Israelis compared to the US. Um, so, and as I say, there's also no sign of sort of domestic uprising in Iran. And keep in mind that, for example, the Israelis and the Americans are actually starting to destroy some of the, hundreds of year olds, if not thousands of year olds, sort of Iranian cultural treasures, like in Isfahan, the old mosques, and there was a museum and whatnot. And this kind of stuff is going to, if in my humble opinion, is going to solidify national sentiment. And even though a lot of Iranians are probably seemingly against the incumbent regime, if you go around blowing up, 2,000-year-old or 1,000-year-old mosques in places like Isfahan and sort of cultural treasures in the middle of Tehran, and destroying hospitals, this will stoke nationalist sentiment. Anyway, I'll end it there, but all I'm trying to say is that there doesn't seem any sign of sort of internal regime change happening either in Iran or being caused externally. So what does that mean for markets? It means that oil is grinding high. So there's gasoline. Let's go back to oil. You can see that oil continues to grind high. It's down off the highs at about $96 we had pretty early overnight, just with the tankers. But definitely, I think what global leaders wanted was this price to come back down into the 70s because of the strategic petroleum release, but that's not happening. So at this point, we have very elevated sort of crude oil prices. We have elevated gasoline prices. We also have nat gas remaining elevated, and we have, for example, the Dutch TTF contract, which is the European benchmark, also very elevated. So the cause of all this, the main issue here is really sort of inflation worries. And and the best way to see that is just to look at the yields. So if we look at the yields, they absolutely were skyrocketing last night, but they've come in a little bit. But you see here, for example, the 2-year yield. I mean, we now have a situation that in Europe, the Euribor contracts are pricing in 1.5 hikes, not cuts, hikes from the ECB in 2026. So the first hike is priced in by the middle of the year, and another half hike. So about 36 basis points of hikes are priced in. And you can see that here with the 2-year yield, you see the 5-year yield almost at highs here. Look at the 10-year yield spiking to almost 3% here. And then if you look at the 30-year yield, which we'll get to in a second, very high as well. So the point is here is that in the European space, massive fears about sort of inflation and the energy induced. And if we go to the US, we can also see here that at the front end, the 2-year yield, I mean, spiking and actually disturbingly sort of breaking out of the range. So you can see here that the 2-year yield spiking up to almost 3.7. And then again, if you go, let's say, to the 10-year, also very elevated, and the 30-year over the last, sort of since the beginning of the war. So the point is that yields are ripping higher. And at what point will this really negatively affect the US equities? And what's interesting, if we actually just look at the inflation, it was kind of lost a little bit yesterday, but we had the CPI, which is relatively positive. So if we look here, I just want to look at the SOFR curve as well. This was snapped yesterday, so I haven't updated it overnight. But you can basically see here where the pain is. This is the SOFR. So each little dot here represents, of course, 3 months, and it's the future curve. And what we can see here is that this is the implied yield. So look at these numbers on the right-hand side. So you can see here, if we go back, let's say on the 18th, so maybe a week before the hostilities broke out, so which is the blue here, you can see that since then, the sort of the trough or the terminal rate, so what were the biggest cuts were around about maybe about 3.08 or so. You can see that they've ripped a lot higher. And you can by to the tune of 20 to 30 basis points, depending on the contract. But really, where the biggest change has been expectations for the end of this year. So sort of December 26, March 27, June 27. You can see all of these contracts. The implied yields have gone much higher. So you can see now that the sort of the low point, the terminal, like where the market thinks the Fed will cut down to, has moved by essentially 20 to 30 basis points has been priced out, and it's now turning into a relatively shallow cutting cycle. So definitely much hawkish. But it's interesting that this is all being caused by the energy spike, because if you look at a breakdown, I'll just grab some tea. if you look at a breakdown of the CPI yesterday, it was actually relatively sort of good news in a sense. So you see that the core services are still relatively sticky, but they are starting to diminish a little bit. And then if you look at the core goods and energy and food, well, energy obviously doesn't include the Iranian thing, so that's going to be a very, very different situation in the next month. But basically, that was trending all in the right direction, just over sort of 2%. And then if you look at different ways of measuring it from like the Atlanta Fed, you look at the trim mean, you look at the median, the super core, all those sort of prices which remain are difficult to the sort of inelastic, so to speak, the sticky price, they're all trending in the right direction. So that's all pretty good news. But of course, if you look at the inflation swap, so we've got here the 1 year inflation swap in the blue, and the 2 year in the black here, of course, they're all ripping higher. So the problem now is that inflation was going in a pretty good direction. We could say, oh, the Fed is probably going to cut, maybe twice this year, maybe even 3 times. But now, of course, with this energy, that is no longer the case. So really, the key question for the incomer, Kevin Walsh, who we assume will take over the Fed chairmanship, in the middle of the year, is going to be, is this war going to continue? Is the oil spike, the energy spike, will that dissipate relatively quickly, maybe over the next 2, 3, 4 weeks? Or if this continues, this is going to become a complete nightmare, and we may even be looking at sort of hikes, which of course is going to be a big, big, big problem with our friend in the White House. But so let's see what happens. But from in terms of the markets now, we've seen that all of the yields ripping higher, and if we start to look at some of the bonds, let's say just look at the 10-year, the ZN, you can see that this thing has collapsed over the last 6 or 7 days, which of course is the opposite price to yield, so yields ripping higher. You can also see at the long end, so the ZB futures contract here, massively sort of down. How many points has come down? Sort of 5 points or so, which is about 150 ticks. So really, the question is, we continue to have elevated volatility. You can see the VIX, in the mid-20s, and just actually talking of the VIX, just want to look at just see how that's changed. So if we go here. And just look, what I've done here is look at the VIX curve on the February the 26th. So this is on the Thursday before the first attacks, and you can see that was in its nice sort of state of contango. So the front of this is the futures curve. So you see that here, that was around about 19 and a half, but well below the rest of the curve. So which indicating no short-term stress. Boom, cut to the live pricing, which is today. You can see just obviously the actual sort of numbers of the VIX have gone up. You can see that the shape of the curve has flipped into backwardation, which means that the front prices are much higher than those further out the curve. So you can see this is indicating a lot of short-term sort of stress and nerves. And really what we're going to have to see is this come back down to flat and eventually go down to a state of contango. But we're not there yet. And you can see that also the actual sort of the VIX spot is above the future the future curve. So all that to say that volatility remains elevated. But what's interesting is the equities, I would say they're actually sort of hanging in there relatively well. Now, are they trading weak? Yes. Did they sell off on Monday? Yes. But the reality is they're sort of hanging in there. And that's just because certain sort of sectors are doing relatively well. If we look at some of the subsectors, we can see that the software ETF, the IGV, it's had a couple of sort of softer days, but not doing too badly. We can see the Mag 7s again, sort of hanging in there. We could see also the semiconductors hanging in there. So, and energy, obviously is up as well. So overall, I would say that the US equities are doing okay. I mean, is the chart sort of heavy? There's a rounding top here. Absolutely. And obviously this is trading very much on sentiment and the oil prices. So, so far it's hanging in there. And you have to say, if we do get a relatively quick resolution, I think there'll be a pretty significant relief rally. That's the same as the Nasdaq, pretty similar chart as well. So just trading in relatively tight ranges, and it's almost as though the market is saying, "Hey, the U.S. economy seems to be relatively good. The underlying inflation, as we saw from yesterday's CPI numbers, are relatively good. If we could just get over this sort of massive disruptions to sort of the energy supply chain, we'll get back to what's going well. So let's keep an eye on things like sort of airlines, because obviously there's huge sort of input prices are going up for energy for airlines. So let's look at the JTES, the jets. ETF. And it's an interesting one looking at that because that, for example, is trading sort of very, very heavy as well. And obviously, fuel prices, jet fuel prices are sort of doubling, tripling, quadrupling everywhere. There's less demand. But on the other hand, prices sort of tickets are going up. I know myself, I'm going on a pretty big trip in a couple of weeks, and that was a nasty surprise. So the point here is that jet fuel prices are ripping higher, but also the airlines are able to raise their prices, although there is a demand destruction. So it's an interesting sort of dynamic there. We also have fertilizers. Let's look at some of the. I'm just going to look here at where is that? I think I have that in commodities. If I look here, so if you look at agriculture, kind of interesting what's happening in the agricultural space. You see that those prices are going up because obviously a lot of fertilizer passes through the Straits of Hormuz. So fertilizer prices going up. So you can see here the DBA agriculture index is going up. You can also, I want to have a look at here, the agribusiness MOO, MOO is the ticker. That had been selling off, but you see this starting to push a little bit higher. Intrepid Potash going higher. These are all sort of agrochemical sort of companies and ETFs, so IPI. We also have Mosaic, MOS, also ripping much higher. So what we're seeing is that the fertilizer cost going up is starting to sort of push through into some of these fertilizer companies. You can see here that Nutrien, which is very heavily involved in the fertilizer and agricultural chemicals business, is going higher as well. So that is going to start putting upward pressure, inflationary pressure on price on the food prices. So we have food prices going up. We have energy prices obviously going up. Let's look at something like corn on the futures just to see how we're going with the corn futures. Just have a look at that. And as you can see, that's going up as well. So we now have twin inflationary pressures, despite the good news we had yesterday with the CPI. So at a minimum, yeah, you've got to say that if we look at the Fed, just the Fed tracker here, just have a quick look here at the Fed watch. Just let that load up. We can see if we go out to, let's see, we'll go out to December, just to give a bit of a context here. You can see that there's now a 26% chance of no cuts at all in 2026, which is pretty crazy. And if we do a bit of a comparison, you can see here how, let's say, compared to 1 month ago, that was at 5%. And within the last month, it's gone up to 26%. And even if we look at 1 week ago, although that probably encompasses the war, but really you can see here that the chances of no cuts have gone up, the chances of just one cut have gone up, but the chances of two cuts have gone down substantially. So whichever way you look at it, I'm just very curious to see what happens with the stock market here. We've got very elevated sort of yields. We have market pricing of a less dovish Fed. Now, we do, as we say, some parts of the stock market, energy, sort of food, fertilizers, agrochemicals are going up. But at a certain point, it's going to be interesting to see whether we get a substantial crack in that. What we do have today is also we have initial jobless claims. So let's keep an eye on that. And just see if that gives us any extra sort of reading on the state of the US employment situation, which it keeps on remaining relatively strong. Okay, guys, I'll leave it there. Obviously, we'll keep an eye on the headlines today and the equities, and also the US dollar continues to remain strong. Some of the commodity producers, such as the Australian dollar, are doing fairly well. And obviously, commodity and energy importers, such as Japan and Europe, are doing much, much less well. So we'll continue to watch those FX, those spaces in the FX as well. Thanks very much. Have a great day. And I'll be back tomorrow with the macro snapshot. Thank you.